In this video, I want to share with you how I think about ASX small caps and US small caps. This video will be an extension on the 3 steps I took to survive the next market correction video. So think of this as one of the ways I'll be capitalizing on the next market correction whenever that happens. At the same time, I've been going on a hunting spree. So I want to share with you a new addition in my portfolio and why I added it towards the end of this video. As usual, this video is not financial advice or recommendation for you to do anything. It's just general information for entertainment purposes. Okay, first, let me talk about why I'm attracted to small caps in the first place. Most blue chip companies at one point was a small cap. Tesla was once a 3 billion market cap company in 2012. And 8 years later, they became one of the world's most valuable companies. That's an incredibly rare breed. And shout out to investors who had that kind of diamond hands to invest in Tesla really early on and then held on all the way through. The same thing exists in the Australian stock market as well. Afterpay at one point was below $1 billion in market cap before they shot through the stratosphere and reached the moon. The point I'm trying to get at is that as I become a more confident retail investor, I'm beginning to see the value of investing in small cap companies and the opportunity to exponentially grow my wealth. By the way, I define small cap companies between $500 million to $10 billion and micro cap companies as below 500 million market cap. The interesting thing also about small caps is that they generally don't get as much coverage as the blue chips, which add to the probability of higher potential upside with very limited downside, as long as you're willing to do the homework, that is. Now, these limited downside and higher potential upside is what people call asymmetric return profiles. The way I like to think about an asymmetric return profile is like a call option. The upside can be significant, but the downside is limited to the amount of premium you're willing to pay for that option. And in a market correction, both blue chips and small caps will both experience a drawdown, at least a very high probability of experiencing a drawdown. Except the upside potential for small caps suddenly just got so much better because there was a market correction. As I've gone deeper in learning more about small caps, I've noticed a few key differences between ASX small caps and US small caps. Again, this is just my own observation, and if you've noticed something different, let me know in the comment section below. Now, firstly, the depth of management team between ASX small caps and US small caps are very different. The US small caps tends to have a lot more firepower when it comes to their execs. And I think that's just a function of having a deeper talent pool to choose from. But ASX small caps, what I found is that they have to fight private VC-funded fast-growing startups like Canva or Safety Culture for their management team. So the pool of talent is much smaller. Not to mention, we only have approximately 24 million people here in Australia anyway. And capital is not as accessible as US. So the amount of money ASX small cap companies can throw around to attract talent is just not going to be as much as the US small caps can throw around. Secondly, if I plot the ASX small ordinaries, which is a proxy to our small cap companies, and compare that with the Russell 2000, which is a proxy for small cap US companies, the return profile after a 5-year period is pretty different. Thirdly, it seems like to me that Australian companies that's working on exciting problems is generally not accessible via the public markets. For example, companies like Airwallex, which is working on a business payment problem, or HyperAnna, which is an AI insights company, or even Eucalyptus, these companies are all VC funded and it's probably not going to be accessible to us for a very long time. That might be because some of these companies are still scaling and it will take time for them to scale and then go public. But even our homegrown Atlassian went to the US to go public. And it seems like it's the opposite for US small caps. Companies solving for exciting problems are more widely accessible in their public markets. However, what is really interesting to me, especially in the ASX small cap space, is our mining companies. That's probably playing to our strength as a nation. And as many of you know, the first couple of small caps that I ever invested in was Novonix and Talga. As of recording this video, the attention of the Australian market seems to be turning towards micro cap companies at the moment. And frankly, that's a bit too risky for me. Instead, I've been hunting in the US small cap space, and this is a really nice transition for me to do a portfolio update. And I want to remind you that this is not financial advice or recommendation for you to do anything. This is just my own reasoning for going down a particular path. So if you do need help with investing, make sure you go see a licensed professional. So for my CMC market portfolio side of things, it's worth about 80,000 Australian dollars. And I have exited my ResMed and my AMD position in order to make rooms for 2 SPACs. So the 2 SPACs I've invested in is Fuse and also Stick. Now nothing else have changed in this portfolio, but Fuse is going to merge with a company called MoneyLion. It's a fintech company, and Stick is going to merge with BarkBox, which is a directly to consumer subscription box company. I'll talk more about why I invested in BarkBox in just a second. Now with my stake portfolio, it's worth about 41,000 US dollars. And the big changes I did make is that over the week, there was a couple flashes of correction that happened. And as the correction happened, I actually bought more of HIMS. I've added a new position called Porch, and I've added more into that as well. And for Twilio, I've also added more as it went down because there was no reason for the share price to get beaten up. Other than that, everything else is still exactly the same. I do want to remind you that my time horizon is about 5 years, so I don't plan to sell any of these anytime soon, unless I need to make room for a new position or my investment thesis change in any of these. Then I will probably offload some of my smaller names, like for example, ARK or Apple or Microsoft, things it's probably more as an instrument for me to preserve my buying power. Now I'll talk about why I added MoneyLion and also Porch into my portfolio in the next couple of videos, because if I add it into this video, it's just going to be too long. But I will talk about why I added BarkBox into my portfolio. Now BarkBox actually started as a dog treat and plush toy subscription business. If you have a big dog, those toys aren't going to last very long. A good friend of mine has a Cavalier and he destroys these plush toys. So imagine having a big dog like a Labrador or a German Shepherd. Now beyond the subscription boxes, they've expanded their offerings into essentials, which are like beds, leashes, collars, and dental, not to mention some personalized food products for the doggies. Now the other thing to note here is that 100% of everything that Bark sells is designed and made exclusively for them. Now as of recording this video, they've grown really quickly before the pandemic and currently has 1.1 million active subscriptions and 6.5 million customers. Now the reason why customers and subscriptions are different is that these are ongoing monthly subscriptions, and Bark customers could buy for a couple months and then they discontinue. And the crazy thing about BarkBox is that unboxing BarkBox became a monthly thing. So if you go on YouTube and you type in BarkBox, you can actually see people making videos around unboxing those BarkBoxes and seeing the reaction of their dogs to the toys, to the plush toys and treats inside the box. That kind of viral acquisition loop is very hard for companies to create. So obviously, as people build more and more content around unboxing BarkBoxes with their dogs, that kind of distribution will lower the customer acquisition costs. Co-founder Mark Mika is still on the board as an executive chairman, and he previously founded Meetup in 2002. Since the company grew really quickly, Bark actually hired Manish from Amazon Global to help scale the business. CFO John Toth was an investment banker in JP Morgan and Goldman, and the SPAC sponsors Joanna Coles is an executive producer in Disney, not to mention she was the previous editor-in-chief for Marie Claire and Cosmopolitan. So the management team is incredibly deep. What's really interesting to me about BarkBox is that because they are a monthly subscription, they're leveraging their customers to learn a lot more about the doggies. And because of the data points they've accumulated, they're able to build customized BarkBoxes for those doggies. Those kind of insights is translating into more cross-sells and add to box revenue. And you can see that in the numbers, or at least the growth of numbers right here. So this is not another company that's throwing the term AI into their slide deck here. And what's even crazier is that BarkBox is anticipating their customer acquisition costs to decline in the 2021 financial year. And according to their SEC filing, I'm sorry, the sentence is probably really hard to read, but this is coming from the co-founder Matt Mika, and I quote, "We have an LTV that typically the LTV to CAC ratio is hanging in the 4 times to 5 times ratio. It's higher than 5 times for this year end, for this past year, and we are breaking even on our CAC within 4 months." That kind of unit economics where the payback period is about 4 months and the LTV to CAC is 4 to 5 times, that's not really that easy to come by. And the faster that payback period is, the faster they can redeploy that money to acquire more customers. Not to mention, if we dig into their numbers a bit more, BarkBox have a 94.4% retention rate and a 61% gross margin. That's almost like a software type business gross margin. And this is a dog subscription box company. In terms of SEO, the company is pulling in approximately 375,000 sessions organically, and their organic traffic growth looks really good over that period of time as well. Now, in terms of price, Bark is anticipated to grow their revenue by 41% from the 2020 calendar year to 2022 calendar year compounded annually, and is currently valued at 3.5 times their 2021 calendar year estimated revenue, or 5.9 times the 2021 gross profit. So comparatively speaking, that was a really attractive small cap play for myself. This is just a brief overview on my investment thesis, and I haven't really talked about the distribution channel and the fact that Fidelity is also in the SPAC. So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces and be part of my fortnightly Q&A, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, remember to gently smack the like button right there, subscribe to my channel so that when I release future videos, you be the first one to know. Until next time, my name is David. Otto will always do the honors and see you very, very soon.